All right, let's jump right into a real head scratcher happening in the world of agriculture. You see, the government is forecasting this massive, absolutely record breaking harvest. Now, basic economics tells us that when supply goes way up, prices should go way down, but they're not. So, what's going on here? Let's get into it. So, here's the core of the puzzle, right? The official data is screaming, we've got a ton of grain, which should be pushing prices through the floor. But the market? The market is doing the complete opposite. Prices are actually rallying. It really makes you wonder, what does the market see that the official reports are missing? So, to really get to the bottom of this, we've got to look at the huge disconnect between the official numbers, the spreadsheets, and what's actually happening out there in the real world with the traders. And here's that contradiction, laid out as clear as day. On one side, you have the government projecting a record-smashing U.S. corn crop. But on the other side, corn futures are hitting their highest price in over 2 months. I mean, these two things just don't add up, right? So to figure this out, we've got to play detective and look for some clues. Okay, clue number 1. And this one isn't buried in some government report. Nope, it's coming straight from the folks in the field, from the combines that are actually out there harvesting. And let me tell you, the story they're telling is very, very different. So what you're hearing from the fields is a whole lot of, well, reality. Farmers are talking about serious disease pressure, things like southern rust popping up. Plus, that dry weather we had late in the season, it really took a toll. We're hearing reports of corn yields coming in 50, even 60 bushels below last year's numbers. The bottom line from everyone on the ground is pretty clear. The yields are just not living up to what the government is saying. Not even close. And this quote from Don Roos at U.S. Commodities really nails it. The early thinking is that the crop is getting smaller, not bigger. That's exactly it. Traders are hearing these stories from the field, and they're putting their money on the idea that the final harvest number is going to be way smaller than the official projection. Okay, so the market is already doubting the supply side of the equation, but that's only half the story. There's another huge piece to this puzzle, our second clue, and it's all about a massive and frankly unexpected surge in demand from all over the world. Seriously, it's like the world went on a shopping spree for U.S. grain. Just look at this number for corn. In a single week, export inspections hit 1.51 million metric tons. To put that in perspective, that didn't just meet expectations, it absolutely shattered them. It went way past the most optimistic forecasts. And this wasn't a one-off thing with corn either. Soybeans are seeing the exact same frenzy. Over 800,000 metric tons inspected for export, which, you guessed it, sailed right past what analysts were predicting. There is a very real, very powerful global appetite for American grain right now. No doubt about it. So you have to ask, what's driving this huge shopping spree? Well, a big part of it is a weaker U.S. dollar. The dollar index dropped to a 2.5-month low. And for buyers around the world, that's like putting a giant sale sticker on all American grain. It just makes our crops a whole lot cheaper and a much better deal on the world stage. All right, our third clue throws a whole different element into the mix. High-stakes politics and good old-fashioned speculation. The markets are absolutely buzzing right now about a potential breakthrough in trade talks between the U.S. and China. And just look at the calendar. It's packed. You've got officials meeting in Madrid this week, there's a big phone call scheduled between the presidents on Friday, and there's even chatter about them meeting in person next month. So traders are seeing all this, and they're getting optimistic. They're hoping it means China, the biggest soybean buyer on the planet, is about to come back to the U.S. market in a major way. So, okay, we have rallying prices. That sounds fantastic for farmers, right? Well, not so fast. Here's where the story takes a sharp turn, a real plot twist. Because for a lot of farmers, this price rally isn't a windfall at all. It's more like a mirage. And the problem, when you get down to it, is painfully simple. Yeah, the prices farmers are getting for their grain are going up. But the cost of everything they need to grow it, we're talking fertilizer, seed, fuel, you name it, those costs are soaring even higher, even faster. So what's the result? Their profit margin is getting absolutely squeezed, sometimes to the point where there's no profit left at all. I mean, just to put a number on it, get this. Farmers are looking at having to spend over $100 more per acre just to plant next year's crop compared to last year. $100 more per acre. That's a massive financial hit that pretty much wipes out any benefit from the little price rally we're seeing.
And that pressure is just immense. We've got analysts like Chris Barron saying, and this is a guy who's been looking at farm budgets his entire career, that this is the single worst scenario he's ever seen. When you hear that, it just drives home how incredibly tough things are for farmers right now.
And if you want a really specific, really painful example of this, just look at the upper Midwest. Since China hasn't been buying, places like North Dakota are just swamped with soybeans they can't sell. It's created a huge local glut, leading to what's called a basis blowout, and it is absolutely crushing the prices farmers are getting. So let's just quickly break down that term basis. It's pretty simple, really. It's just the difference between the big futures market price, you see it quoted in Chicago, and the actual cash price a farmer gets when they deliver their grain locally. And when that basis gets really, really negative, it means the farmer is getting paid way, way less than that big headline price. And in North Dakota, it's just a disaster. That basis has collapsed to a negative $1.50 per bushel. That's the worst it's ever been. So think about that. The futures market might be saying soybeans are over $10, but some farmers are actually getting offers as low as $8.50. That is so far below their cost of production, they are literally losing money on every single bushel they sell. Okay, so we've looked at all the clues, right? We've got doubts about the actual supply, we've got this incredible surge in demand, we've got the wild card of geopolitics, and we've got the very real economic pain on the farm. Now let's put all those pieces together and solve this thing. What this all boils down to is a classic tug-of-war in the market. You've got one team, the traders, betting that the supply is a lot smaller than everyone thinks. And on the other side, you have this powerful team of real, global demand, supercharged by a weak dollar, pulling prices up. Then you throw in the uncertainty of the US-China situation and the grim reality of farm profits, and that's why we have the crazy, volatile market we're seeing right now. And really, if you take away just one thing, it should be this. The whole puzzle comes down to a tense standoff between potential supply and actual demand. The market is weighing the possibility of a giant harvest against the reality of super strong demand that's happening as we speak. And for now, at least, reality is winning. Demand is pulling harder. So that leaves us with one big final question. Because this whole complex dance of supply, demand, and politics, it isn't just some abstract numbers game for traders. It has real-world consequences for farmers' livelihoods and down the line for the entire global food supply. So as these huge forces keep playing this tug-of-war, you have to wonder, how is this delicate balance between the price on a screen and the food on our own plates going to be affected?